Greetings, everyone. I'm David Darst, here to give you a recap of the month of August, the 8th month of the year. This year has been really racing by, as you know, with all of the developments in the political sphere, the economic sphere, the financial sphere, and the geopolitical sphere. I think the month of August, one of the key developments was the speech by Chair Powell of the Federal Reserve at Jackson Hole at the Central Bankers Symposium towards the end of the month, where he said basically the labor market is cooling. And he said the Federal Reserve really does not welcome or want to hasten that cooling. And he says it's unlikely that the labor market will be adding inflation pressures anytime soon. Timing of the interest rate cut, which is expected this coming month in September, he said will depend on three things. One would be incoming data. Secondly, would be the evolving outlook. And thirdly, of course, would be the balance of risks. He said explicitly the time has come for policy to adjust. So markets really understood this in a very clear fashion and responded somewhat. The two-year Treasury, which is very indicative of what the Fed's thinking is and what their likely movement is going to be, the two-year Treasury closed or got close to 383, which was down 46 basis points from 429 at the end of July. So he had a big move downward during the month of August. Also, the 10-year, which, as you know, is really indicative of inflation and the economy, the 10-year also closed at 383. And that's interesting because remember this inverted yield curve, and that's becoming less and less inverted. And right now, the yield curve is flat between the 2-year and 10-year. It's also 383. So that means it declined 26 basis points during the course of the month of August. Now, the backdrop from the economy, the ISM services was released mid-month at 51.4. It's jumped back above 50, which means it's in expansion mode. However, I would point out and remind everyone that the two of the last 3 months, it has been below 50, which means in contraction mode. And the ISM manufacturing really is, and many of the regional Fed surveys, the Dallas Fed, the Philadelphia Fed, the New York State Empire's manufacturing, many of these regional Fed surveys are showing continued slowing in the manufacturing sector, which we've highlighted for you. The lead economic indicators, they have been down for 27 of the last 28 months. The last time they were down 22 months was just before the great financial crisis of 2008-2009. Does not mean for sure, but in the month of July, which was reported mid-month in August, it was down 0.6%. And so the next one we'll be looking forward to is going to be on the Thursday, the 19th of September, which will be the day after the two-day Fed meeting in September, September 17th, September 18th. The labor market, Chair Powell said it's cooling. Yes, we had this benchmark revision. They do this every year. And the March 2023 to March 2024, they basically look carefully at all the data and revise the employment data. And you see that the total number of jobs was actually 818,000 less than the sum of the 12 monthly job reports of the Bureau of Labor Statistics. So that shows also, and I think it confirms what Chair Powell was saying, the labor market is definitely cooling. Growth is moderating. You remember the first part of the year, first quarter, the GDP was up 1.4%. Second quarter, 2.8%. Third quarter is expected to be about 2%. So it would be slowing down from 2.8% for the second quarter. And you would note that earlier in the month of August, earlier this past month, it was 2.9 for the third quarter. So it's been continuing to slow down. Against this backdrop, we had the Consumer Price Index and the Producer Price Index. July Consumer price index on a headline basis was 2.9%. That's 3% for the month of June. So you see a little bit easing in inflationary pressures. 3.2% core. That's taking away food and energy prices, as you know, and that was 3.3% in the month of June. Same thing with the producer price index on a headline basis, 2.7 down to 2.2, but the core on the producer price index, the core was actually up from 3.2 to 3.3%. The New York Fed produces this survey of consumer expectations, which we watch carefully. The one-year inflation expectations last month were 3%. This month, also 3%, so no change. The three-year inflation expectations, and I'm just wondering about this data point, it went from 2.9% to 2.3% expectation. So a big drop. So many of the respondents to this survey are basically thinking, well, inflation is going to remain high for the next coming year, but then drop. That's the expectations part of this these responses to the survey, and the 5-year unchanged at 2.8%. As we basically position ourselves for the month of September, we would remind everyone, over the last 95 years, September is the worst month on average. Does not mean it can be above average, it can be below average. The last 95 years, September has the worst of the 12 months. People come back from their vacations, they get ready to go back to school, and they start to get involved with the hustle and bustle as we approach the last quarter of the year, the final continuation and ending and conclusion of each year. September, minus 1.1% on average. And I would remind everyone, the last four that we've had of the last 4 Septembers have not been good Septembers. Listen to this: minus 3.9%, minus 4.8%, minus 9.3%, and minus 4.9%. So the last 4 Septembers, given the law of averages, you would think maybe this September at least could be up after 4 down, and the average long term is minus 1.1. So you would expect from the law of averages, as we position ourselves, looking at the S&P 500, it's up. The S&P 500, the NASDAQ, and the banks all together, as August drew to a close, were all three up around 18%. Volatility did increase a little bit, but not hugely. 15.4 or thereabouts for the VIX index. Gold has continued during the month to make new record highs, up about 22%. The dollar, with expectations of the Fed bringing interest rates down, the dollar basically has moved from being up 3-4%, the DXY index, to being essentially flat. As we now position portfolios, we would remind everyone our emphasis: we like credit, liquid credit, and also particularly private credit, where you can pick up for similarly rated securities or security position in the capital stack. You can pick up yield by getting private credit rather than publicly traded or liquid credit. We like private equity. These new launches, there have been some on infrastructure and also in classical private equity. We like those, and we like secondary, the purchase of secondary interests, where many of the holders, the limited partners of these private equity interests, are selling them in order to raise cash to pay out to their constituencies. With that, we wish everyone a great start to the month of September. Thank you for being with us. All the very best to you.